In this final video, we're going to talk about the taxation of trusts.
Let's talk about the taxation of trusts. Trusts in general. Now, a trust is a legal entity, and it's created under the laws of the state in which it is formed. There are many different types of trusts out there. It's a unique legal specialization as well as a tax specialization. And it varies from state to state what type of trusts are available in that particular state. I'm just going to talk about the basics of trusts in a very general way because I want you to understand them for the test. But this is only a very brief overview about trusts in general. Now, the first thing that I want you to realize is that a trust is not a business. That's not what it is. A trust can hold a business, but a trust can also hold things like personal use assets, like your main home or your vehicles even, something like that, paintings, whatever. It can hold investment property. It can hold business property. It can hold personal use property. Trusts are designed to hold property. That's what they're for. They're not businesses. They're designed to hold assets. A trust can be created during an individual's life. This is called an inter vivos trust. I can create a trust right now while I'm alive. Or a trust can be created at the time of death under the stipulations of a person's last will and testament. This is called a testamentary trust. And many people will include this in the terms of their will to create a trust, a testamentary trust upon their death. Basically, the decedent or the taxpayer is the one that chooses. A trust is generally created to hold property for the benefit of other persons, most of the time. That's why a trust is created. They're very frequently used for estate planning. Like, for example, if I were to create a trust, I could transfer all of my assets, including my personal use assets, my copyrights, my trademarks, the stock that I own. I could transfer that all to the trust, and the trust will hold it. And then I can create a trust that includes terms on how the assets would be distributed upon my death. Like, for example, I want all of my assets to go equally to my 3 children. And one of the big benefits of using a trust is that having a trust will generally avoid probate. Many people will have a will as well as a trust. They'll have both, but a trust is many times used to avoid probate, which can be costly depending on the state. For example, in California, even a small estate, the probate fees can be thousands of dollars. So depending on the state, many people will create a trust in order to try to avoid probate or to distribute their assets in a controlled manner, whatever. Most of the time, trusts are created to hold property for the benefit of natural persons, people. Like, for example, if I created a trust, then the beneficiaries of that trust are probably going to be my children and my spouse. That's why I would create a trust personally. But many times people will create trusts for the benefit of entities, especially charitable entities. Like, people will create a trust and say, okay, upon my death, I want all of my assets to go to my church, or I want my assets to go to these 3 charities, which are my favorite charities. Trusts can also be created to benefit even animals. I saw a post recently where it was a couple that didn't have any children, or I'm assuming any other close relatives, and they wanted to create a trust for the benefit of their pets. So even that's possible. But generally, a trust is created to hold property for the benefit of other persons, usually a person's heirs. For example, their children or their spouse or some, grandchildren, whatever. That's why trusts are created. The establishment of a trust creates a fiduciary relationship between 3 parties, and you have to know these for the test. The grantor. This is also called the settlor or the trustor. These names are used interchangeably. They basically mean the same thing. This is the person who contributes property to the trust. The trustee or fiduciary. This is the person or the entity charged with fiduciary duties associated with the trust. The trustee is the one that is responsible for filing the trust income tax returns, which is the Form 1041, not the grantor. This is the trustee's responsibility. And then lastly, the beneficiary. This is the person who is designated to receive the trust income or the trust's assets. And you can have multiple beneficiaries for a trust or even just a single beneficiary. Usually the beneficiaries are natural persons, humans, but you can have beneficiaries that are entities as well. For example, a charitable group or a charitable organization are very commonly named as beneficiaries of trusts. There are many different types of trusts. A trust can be created for the benefit of a disabled individual, and this is the type of trust that I'm going to talk about the most in this webinar because I feel like a qualified disability trust is one of the best examples of why someone would create a trust in the first place. Because all of this costs money. Creating a trust is not free. Usually you have to pay a lawyer to do it, right? You have to create this entity under state law. So this is something that is not free to do, but a qualified disability trust is a very powerful tool to benefit a disabled individual. That's the example that I'm going to give you in this webinar, a detailed example. A trust can be created to benefit a charity, or it can also be used to legally avoid certain taxes. Now, types of trust. There are many different types of trusts, many types of trusts, but the two basic types are revocable and irrevocable. A trust is going to be either one or the other. A revocable trust allows the person who created the trust to retain control over the assets in the trust and revoke or change the terms of the trust at any time. For tax purposes, revocable trusts are treated as if they are still owned by the grantor, so all items related to the trust are reported on the grantor's Form 1040 returns. This is typical of a grantor trust. Many times these are called like living trusts, living revocable trusts, that sort of thing. These trusts are used most often to avoid probate if it's a revocable trust. With irrevocable trusts, the assets in the trust are no longer controlled by the grantor. So the grantor will put assets into the trust or transfer assets into the trust, and then the grantor no longer owns those assets. Assets in an irrevocable trust are not included in the estate of the grantor, which is the huge benefit of an irrevocable trust. Once you transfer assets into an irrevocable trust, then they're no longer owned by the grantor, technically, and they're not included in the estate of the grantor. This is one of the most powerful tools that wealthy people use in order to give assets to their favorite charities. They'll create irrevocable trusts that are charitable trusts and transfer assets into that trust in order to benefit their favorite charities. And then those assets are no longer includable in their gross estate. So if they die, then they're not going to be subject to estate tax. Removing assets from a person's estate is one of the main reasons why irrevocable trusts are formed. Upon the death of the grantor, a revocable trust automatically becomes irrevocable. Remember this as well. If I create a revocable trust during my lifetime, a revocable trust means that I retain control over it. I can make changes. I can take assets out. I can put assets in. It's all treated as if I own those assets, and any income that comes into a revocable trust is just reported on my Form 1040. Like I could transfer investments into a revocable trust. If those investments earn interest or dividends, then I just report them on my Form 1040 while I'm alive. As soon as I'm dead, that grantor trust is going to become irrevocable, which means it can't be changed anymore. Assets can't be put in and taken out. Because upon the death of the grantor, let's say it's my trust, if I die, then that revocable trust is going to become irrevocable upon my death. It's basically frozen and no more changes can be made. A testamentary trust also becomes irrevocable upon death. A testamentary trust is a trust contained in a last will and testament of a decedent. Sometimes a trust is used to transfer property in a controlled manner. For example, a parent may wish to transfer ownership of assets to his or her child, but does not want the child to waste the assets or spend them unwisely. The assets can be transferred to a trust with the parent as both the grantor and the trustee. The child would be the beneficiary. The parent still has control over the assets, and the child is prevented from using them all up. Now, let me give you an example. Rose is having serious medical problems and decides to put her assets in a trust. She asks her attorney to create the trust as well as manage the assets. The trust is structured so it will pay Rose's living expenses, with the remainder of the assets going to her grandson after she dies. While Rose is alive, the trust is revocable, so she can make changes to it while she's alive. And Rose still controls the assets in the trust. Upon her death, her revocable trust automatically becomes irrevocable. And then there will be a filing requirement for the trust itself, which is the Form 1041. While she's alive, if the trust has revenues and it's a grantor trust, then she can make changes to it, and the income that comes into the trust is just going to be reported on her Form 1040. That's typically how it's done. But upon her death, her trust is going to become irrevocable, and then at that point, it will have its own filing requirement. In this scenario, Rose is the grantor, her lawyer is the trustee, and Rose and her grandson are both the beneficiaries of the trust. Now, there's nothing shady or illegal or offhanded about doing this. The IRS does watch for abusive trusts a lot, but trusts are very commonly used for this exact type of estate planning or life planning. And I've seen this done on multiple occasions with clients. In this situation, Rose has a grandson that she wants the assets to go to, but maybe the grandson is a minor and those assets can't pass to the grandson. Many times, grandparents will do this because they want to provide income or assets to their grandchildren, but maybe the grandchildren are still minors, so those assets can't be passed to the grandchildren yet. But the grandparents already have some kind of a diagnosis, or they feel like they're ill or getting up there in years, and they want to make sure this is taken care of before they actually pass away, because they want to make sure that the assets go to the grandchildren or to the heirs that they've specified. They want to make sure that, I want all of this to go to this particular grandson or to my grandchildren. I've also seen trusts like this used where the grandparent has grandchildren that they want to provide for, but maybe the parent of that grandchild is like a drug addict or can't manage their money at all. I've seen that on more than one occasion too. In this case, Rose creates the trust, and then the lawyer is the trustee. And then the assets are going to go to her grandson in a controlled manner after she dies. The income and the assets are going to go to her grandson. And this way you can maybe skip the parent who might be a drug addict or who might not be able to manage their money or whatever. For whatever reason, you don't want the parent to actually control the income in the trust, or you don't trust them. So you want to make sure that the money actually does go to the grandchild and doesn't get spent by the parent. Accounting and filing requirements. The accounting period for a trust is generally the calendar year. There are some fiscal year trusts out there, but generally a trust is going to be the calendar year. If it's a calendar year trust, it's the same filing deadline as an individual taxpayer. It's April 15th. Form 1041, U.S. income tax return for estates and trusts, is used by the fiduciary of a domestic trust to report the income, deductions, gains, losses, etc. of the trust. And many times, trusts will have multiple sources of income. A trust can have rental income because a trust can hold rentals. And many times, wealthy people will choose to use a trust to hold their rentals or to hold their real estate rather than something like an LLC. They'll choose a trust instead. Trusts can also be used to hold things like stock, bonds, other types of investments, and even something like paintings or collectibles sometimes will be held in a trust. And this is especially true if it's something like a very valuable type of painting. Like, let's say your family happens to own 3 Van Goghs or 10 Picassos or something. Many times trusts will be created to hold a collection like that. The collection will many times be held in that trust because the people who purchase those paintings want those paintings to stay together as a group. People will form trusts to hold that type of an asset, and then the trust itself will lend out those paintings to museums and other charitable organizations like colleges. Sometimes people who are wealthy will create trusts just to hold specific assets, like in a group like that. Like, oh, I have 5 Van Goghs or I have 10 Picassos, and I'm going to hold them in this trust because I don't want these to be broken up and sold after I'm dead. I want them to be like lent out to museums and colleges and things like that. The Form 1041 is also used to report income that is either accumulated or held for future distribution or distributed currently to the beneficiaries, and any income tax liability of the trust. A trust is required to file Form 1041 if it has any taxable income for the year after subtracting the allowable exemption amounts. And we're going to talk about the exemptions that apply to trusts. The Tax Cuts and Jobs Act did away with the personal exemption for humans. But the Tax Cuts and Jobs Act did not do away with exemptions for trusts. So you have to know that for the test, the amounts. If the trust has gross income of $600 or more, this is regardless of whether the income is taxable or not. So for example, if you have a trust that is just holding like muni bonds, let's say it's just muni bonds, and it's only getting muni bond interest is not taxable. But if, for example, the trust has gross income of $600 or more, even if it's all like muni bond interest and it's not taxed, you still have to file a Form 1041 for that trust. And then if the trust has a beneficiary who is a non-resident alien, then even if the trust has just like $1 of income, it has to file a trust tax return, a Form 1041. So just remember, if there's a non-resident alien anywhere in the mix, whether it's an estate or a trust, then that is going to trigger a filing requirement for the Form 1041 if there's any beneficiary who's a non-resident alien. Now, trusts are allowed a small annual exemption, but the amount varies on the type of trust that it is. A trust that must distribute all of its income currently, this is also called a simple trust, is allowed an exemption of $300 per year, which means that if you have a simple trust, even if it's an irrevocable trust and normally would have a filing requirement, if it has less than $300 per year in income, then it technically doesn't have to file a tax return. As long as there isn't some other type of trigger, like for example, if it has a beneficiary that's a non-resident alien, then in that case, the trust would have to file a tax return, even if the income was below this. A complex trust is allowed an exemption of $100 per year, with the exception of a qualified disability trust. A qualified disability trust, also called a QDT, is allowed an exemption of $4,400 in 2022. You might recognize this number. This is basically the gross income threshold for a qualifying relative dependent. It's $4,400 in 2022. This is the same amount that taxpayers would have gotten as a personal exemption if the Tax Cuts and Jobs Act hadn't done away with personal exemptions. What the Tax Cuts and Jobs Act did was it did away with the personal exemptions, and then it doubled the standard deduction. That bill was trying to like simplify the tax reporting process so that fewer people would have to itemize. That was the reasoning behind it. The Tax Cuts and Jobs Act did away with the personal exemptions, but it didn't do away with the exemption amounts for trusts. So if you have a simple trust, it gets an exemption of $300. A complex trust gets an exemption of $100, but a qualified disability trust gets an exemption of $4,400. And what this translates into is that a qualified disability trust can retain $4,400 tax-free every year. So it's a very powerful tool for taxpayers who want to provide for a disabled individual. Example, the Randall Family Trust has $200 of tax-exempt interest from municipal bonds during the year. So the only income that came into the trust was from muni bonds. There is no other income. Normally, the trust would not be required to file a tax return because the income earned by the trust is tax exempt. There's no tax in this case. However, the Randall Family Trust has a beneficiary who's a non-resident alien. One of the beneficiaries is a non-resident alien. Therefore, the trust is required to file Form 1041. Okay, so there's no income. There's no taxable income. There is income. It's only $200, and it's tax-exempt interest. Normally, this trust would not have to file a tax return because there's no taxable income. But because there's a beneficiary that's a non-resident alien, then that will trigger a filing requirement by itself. Now let's talk about simple and complex trusts, the difference between the two. You need to know this for the test. A simple trust is a trust that has to distribute all of its income currently. In other words, it cannot accumulate income from year to year. That's a simple trust. It makes no distributions of principal, and it makes no distributions to charity. That's a simple trust in a nutshell. Got to remember that for the test. Any trust that is not a simple trust is automatically classified as a complex trust. If it's not a simple trust, it's going to be treated as a complex trust. Only complex trusts may accumulate income. If you have a trust that's accumulating income and the income is not distributed to the beneficiaries, then that's automatically going to be treated as a complex trust. A complex trust is allowed to accumulate income. It can make discretionary distributions of income. It can make mandatory or discretionary distributions of principal, and it can make distributions to charity. So if you have a trust that is distributing income to a charity, then it's going to also be treated as a complex trust. A trust can be a simple trust in 1 year and a complex trust in a following year. So it's possible for a trust to be a simple trust in 1 year and then a complex trust in the following year or in the next year. For example, if a simple trust fails to distribute all of its income in the current year, then it will be treated as a complex trust in the current year. Trust taxation in general. Now, this is in general. We're not talking about all the time, because when it comes to tax law, everything's about exceptions, right? But in general, a revocable trust does not file a separate tax return. Its income is attributed to the grantor, who reports it on his or her personal income tax return. An irrevocable trust, however, is the opposite. It's considered to be a separate legal entity and must file a separate tax return if the income threshold is above the exemption amount. Remember those exemptions that I just talked about. It is the trustee's obligation to file the trust tax return, not the grantor's. It's the trustee's job to do that. A grantor trust is a valid legal entity under state law, but it is considered a disregarded entity for federal income tax purposes. A grantor trust is treated similarly to a disregarded LLC. It's just treated as if it's owned by the grantor. The grantor creates the trust and retains control over the trust. Revocable trusts are grantor trusts in which the grantor retains the right to make changes or end the trust during his or her lifetime. The benefit of this type of trust is that the grantor retains control over the trust. The drawback is that the trust assets are subject to estate tax upon the grantor's death. If the taxpayer actually is wealthy enough to get hit by the estate tax, which means basically that their assets are worth more than that $12 million exemption amount, then this is the big drawback of a grantor trust, is that the assets for estate tax purposes are still treated as if they're owned by the grantor. It's good because grantor trusts can help you avoid probate, but on the other hand, the drawback is that the assets are treated as if they're owned by you, and they're subject to estate tax if you are talking about someone whose assets are worth more than the estate exemption amount, over that $12 million exemption threshold that we were talking about in the estate tax law webinar. Many taxpayers will use this type of trust instead of or in addition to a will. It's smart. I believe that it's smart to have both. I believe it's smart to have either a trust or a will. I personally think a will is more important because that's where you outline your wishes. But many people will use a trust in order to avoid probate, and they won't bother with a will. But many people will have both. They'll have a trust as well as a will. Non-grantor trusts. Now, a non-grantor trust is considered a separate legal entity from the individual or organization that created it because the donor of the assets gives up all control. That's the drawback of a non-grantor trust. The trust itself is treated as a separate taxable entity. The trust income and deductions are reported on Form 1041. This type of trust actually does have a filing requirement if the trust actually generates taxable income that's over the exemption amount. But many times these types of trusts will just be used to hold assets that don't generate revenue. Like I said before, many times people will use non-grantor trusts to hold assets to benefit a charity, like paintings. If it's something like paintings, they're just sitting there. They don't necessarily generate revenue, that type of an asset. You can use a non-grantor trust to hold something like land that's just being held for investment too. So just because it's treated as a separate taxable entity doesn't mean it's going to have a filing requirement. If the assets in the trust are not generating income, then the trust is not going to have to file a tax return. But sometimes the assets in this type of a trust will generate revenue. For example, let's say you have a non-grantor trust and it's holding lots of stock. Stock is going to generate something like dividends. Then in that case, then the trust itself might have a filing requirement. And if this type of a trust, a non-grantor trust, does generate revenue above the exemption amount for the type of trust that it is, then it has to file a Form 1041. That's a trust income tax return. If a non-grantor trust makes distributions to a beneficiary, in general, those distributions are taxable income to the beneficiary. So a trust is going to have beneficiaries, and if the trust actually distributes income to a beneficiary, then it's reported to the beneficiary on the Schedule K1, just like as if it was a partnership or an S corp. That's how it's treated. It goes on the Schedule K1, and then the beneficiary has to report that income on their individual tax return if the beneficiary is a human. If the beneficiary receives income from a trust, taxable income from a trust, then the way the beneficiary reports it on their individual tax return is on Schedule E, page 2 of the Schedule E. We're not going to talk about that type of reporting very much here, because here we're talking about the entity itself. We're talking about the trust itself and the trust filing requirements. But if the beneficiary receives income from the trust and it's taxable income, then it goes on the Schedule E of the Form 1040. There's a special place for it. Now here are 3 examples of non-grantor trusts. This list is not comprehensive. There are many, many, many different types of trusts that exist out there, and the options that you have to form a trust are going to vary from state to state. Some types of trusts are available in some states and not in others. All of it depends on the laws of the state. But for tax purposes, a non-grantor trust is going to include these 3 types of trusts. An irrevocable trust. This is a trust that cannot be revoked after it is created. Property transferred to an irrevocable living trust does not count towards the gross value of taxpayers' estate. So if I create an irrevocable trust and I transfer assets into it, then those assets are no longer going to be included in my estate because those assets do not belong to me anymore. Now those assets belong to the trust. A qualified disability trust. A qualified disability trust is a non-grantor trust created solely for the benefit of a disabled individual under the age of 65. And I don't know why there's an age limit on these, but there is. It has to be a disabled individual under the age of 65. A qualified disability trust is a complex trust because it is designed to hold income and assets solely for the benefit of a disabled beneficiary. And a qualified disability trust can retain income, and it can also distribute income. And the third type is a charitable trust. A charitable trust is a type of trust devoted to qualified charitable contribution purposes. A charitable trust can allow a taxpayer to leave all or some of their estate to a qualifying charitable organization of their choice. Charitable trusts are not subject to the NIT. They're not subject to the NIT because it's a charitable trust. All of the income goes to benefit a charity. Charitable trusts must be set up for a charitable purpose, and they are always irrevocable. Property transferred to a charitable trust does not count towards the gross value of an estate, and charitable trusts are often used for estate planning when a person wants to give valuable assets to a charity in a controlled manner. Now, here's an example of a charitable trust. Jacqueline Smith wants the majority of her estate to go to charity. She wants the majority of her estate to go to charity. She creates a charitable trust in order to facilitate her wishes. The Smith Charitable Trust has a governing instrument that provides her local Presbyterian church, which is a qualified religious organization. That's a church, it's a 501c3, and the SPCA, a 501c3 charity, are each to receive 50% of the trust income for 10 years. So many times people will do this. They want, a certain amount to go to this charity or a certain amount to go to that charity. Creating a trust will basically facilitate that. she wants the trust income to go to these two charities for 10 years. At the end of the 10-year period, the corpus, which are the assets in the trust, will be distributed entirely to the Smithsonian Museum, which is also a 501c3 organization. Jacqueline is allowed an income tax deduction for the value of the assets she places in the trust. The Smith Charitable Trust is irrevocable, which means that the trust cannot be modified or terminated without the permission of the beneficiary. In this case, the beneficiaries are the charitable organizations themselves. After she transfers assets into this trust, then the only organizations or people, basically, that can modify the trust are the actual charities. She can't make changes anymore. Now let's talk about qualified disability trusts. A qualified disability trust is a special type of trust. It's designed for the benefit of a disabled individual. It can be an adult or a child. And a qualified disability trust is unique because it is allowed a $4,400 exemption in 2022, basically the same exemption amount that would have applied to an individual taxpayer if the Tax Cuts and Jobs Act hadn't done away with personal exemptions. This means that a qualified disability trust can retain this amount tax-free every single year, creating a fund for a disabled beneficiary's future needs. This is tax-free. A qualified disability trust may also distribute this amount tax-free to a disabled beneficiary, but many times with a qualified disability trust, the trust won't. If it has the income to be able to distribute some to the beneficiary as well as retain some, then the trust will do that because this would be tax-free to the trust if it gets retained. The other big benefit for a qualified disability trust is that the income that's distributed from a qualified disability trust is exempt from the kiddie tax, which is huge because many times the people that set these types of trusts up, they are wealthy and they're setting up this type of qualified disability trust to benefit like a disabled child, a child who has maybe Down syndrome or autism or some other disability. And, if you were to pass investments to a disabled individual and it is a minor child, if they just own those investments, then the income that's generated by those investments are going to be subject to the kiddie tax once you reach the kiddie tax threshold. But if instead you transfer those assets to a qualified disability trust and the income is distributed that way, then it's going to be exempt from the kiddie tax, which is a huge benefit. Most deductions and credits allowed to individuals are also allowed to trusts. However, there is one major distinction. A trust is a potential pass-through entity that is allowed a deduction for its distributions to beneficiaries. So remember, estates and trusts are like hybrid pass-throughs. It's not like a C Corp where nothing passes through, and it's also not like a partnership or an S Corp where everything passes through. A trust or an estate can choose to retain income. Those entities can retain income and pay tax at the trust or estate level, at the entity level. Or a trust or estate can choose to distribute that income. And the income that's distributed is taxed at the beneficiary level. It's either or. You're never going to be taxed in both places. Let's say that there's a lot more flexibility with tax planning if it's a trust, because I know that, there's an additional hassle because there's filing requirements for a trust, but you do get more flexibility to either retain income or pass through the income. If it's a situation where you have a disabled person and they would qualify for a qualified disability trust, but you decide that you don't want to deal with, the filing requirements or whatever of actually forming a qualified disability trust, because of course, it's going to cost money to do the filings every single year. And of course, the formation of the trust is not going to be free because you're going to have to pay a lawyer to do it. But if it's a situation where you have a lot of investments that you want to benefit a disabled individual and you're just passing through that income to that disabled individual and it's a minor, then that income is going to be subject to the kiddie tax once it reaches the kiddie tax threshold. But if those investments are instead put into a qualified disability trust, then you don't have to worry about the kiddie tax, which is a big deal, especially if the parents who are actually claiming that child are wealthy themselves. Avoidance of the kiddie tax is one of the main reasons why people will form this type of trust. The beneficiaries and not the trust will pay income tax on their distributive share of income. So if the income is actually distributed to the beneficiary, then the beneficiary pays tax on it. And they're going to pay tax on it at their marginal tax rate, not at the kiddie tax rate. The Schedule K1 of Form 1041 is used to report income that a trust distributes to beneficiaries. The income must then be reported on the beneficiary's income tax returns, which is on the Schedule E of the Form 1040. Now here's my little diagram of a QDT. This is an example of a qualified disability trust. Let's say you have wealthy grandpa. Wealthy grandpa is the grantor. Wealthy grandpa has a disabled grandchild, and he wants to provide for that disabled grandchild. Wealthy grandpa has a lot of income, has a lot of assets, and he wants to transfer assets to a qualified disability trust in order to benefit his disabled grandchild. This is his disabled grandchild down here. She's disabled. She's the beneficiary. And she can't manage these trust assets by herself. Let's say she is severely disabled or has autism or Down syndrome or something like that. She wouldn't be able to manage these assets herself. So the grantor, who is the grandfather, transfers assets into a qualified disability trust. These can be income producing assets, or it can be even something like a main home that the disabled grandchild is going to live in. That's possible too. It doesn't have to be an income producing asset. You can transfer any type of asset to a qualified disability trust, and that asset can go to benefit the beneficiary, which is the disabled grandchild. Now, the trust itself is going to have a trustee. Generally, this is someone like a lawyer. It's not going to be the grantor, and it's not going to be the beneficiary either, because the beneficiary is disabled, remember? So you're going to have a trustee or a fiduciary. Generally, this is a lawyer. Sometimes it can also be another family member. That's possible too. Now, the trust itself, if it has taxable income, like from investments, for example, will file a Form 1041. This is an irrevocable type trust. So if the trust actually has taxable income that exceeds the exemption amount, then the trust has to file the Form 1041 every year. The beneficiary is going to get a Schedule K1, and then the beneficiary has to file an income tax return, the Form 1040. Usually the Form 1040 is filed by whoever is like the guardian of this beneficiary. Okay, sometimes the beneficiary will have a guardian, like an adult parent, but the trustee will be like a lawyer or some other third party. Now, let me give you an example. Nora Wells is 18 years old and has severe autism, so she's disabled. Nora's wealthy grandfather set up a disability trust on her behalf before he passed away a few years ago. So he did this for her before he died. The Nora Trust is a qualified disability trust, or QDT. In the current year, the trust has $19,000 of interest income and made $16,000 worth of distributions for Nora's benefit. So let's say the grandfather transferred investments that are earning interest, like a CD, to this qualified disability trust. The income is going to continue to come in every single year. So there's a filing requirement here where the trust actually has to file a Form 1041. That's the interest income that came into the trust. $16,000 worth of the income that came in, that interest, was distributed for Nora's benefit. The money went directly to pay for Nora's daycare and activities. The $16,000 in distributions is taxed as interest income on Nora's individual Form 1040. It's taxed as interest income to her, just as if it would be taxed to the trust. It's a pass-through. So she's going to have to pay tax on the interest, but despite her age, the amounts are not subject to the kiddie tax. This is regardless of whether she's being claimed by her parents or some other guardian or anything like that. She's only 18. So probably she's being claimed by her parents. Nora, on her individual tax return, which, her parents are probably going to have to file for her, but she still has to file an income tax return, and whoever her guardian is going to be responsible for filing it for her. But Nora can take the standard deduction to shield the majority of income from tax. She's still a person, an individual taxpayer, even though she's disabled and, maybe being claimed by her parents, and her tax return is going to have to be filed by her guardian. She still gets the standard deduction just like everybody else. And it's going to shield the majority of the income from tax. because the income is not subject to the kiddie tax. And this is true even if she's claimed as a dependent on her parents' return. The remaining undistributed income, this $3,000, remember the trust made $19,000 in interest. It only distributed $16,000. The undistributed income, that $3,000, would be reported on the trust's income tax return, which is the Form 1041. And since the trust is a qualified disability trust with a $4,400 exemption, there would be no income tax due on the $3,000 that was not distributed to the beneficiary, who is Nora. So the trust is not going to pay income tax on the amount that it retained. And then Nora is going to be able to shield the majority of the income that got distributed to her from income tax because she gets the standard deduction just like everybody else. So this is a very powerful tax planning device for a disabled individual. Now, let's switch gears a little bit. We're going to talk about abusive trust arrangements. The IRS really watches for abusive trust arrangements because many times when taxpayers attempt to do like tax evasion, they will do it through trusts. And if you look up like abusive trusts on the IRS website, there's a list of abusive trusts that the IRS has basically identified as like abusive tax shelters. Many of them are trusts. That's how they're organized legally, as trusts. Sometimes abusive or fraudulent trust arrangements will be used to hide the true ownership of assets and income or disguise the substance of transactions. They frequently involve more than one trust, each holding different assets of the taxpayer. For example, the taxpayer's business, business equipment, home, automobile, etc. Some trusts may hold interests in other trusts, purport to involve charities or be foreign trusts. Participants and promoters of abusive trust schemes may be subject to civil or criminal penalties. Sometimes people will transfer like their primary residence to a trust and then treat it as if they're renting to themselves, that sort of thing. You can't do that. You can't rent to yourself. You can't rent your own house to yourself and then take deductions for, your lawn care and utilities and everything else out of the trust. But people do try to do it. And that's an example of an abusive trust arrangement. It's possible to actually put rentals into a trust and have rental activity, like bona fide rental activity in a trust. That's possible. And that's not like illegal or abusive or anything. But you can't transfer your own primary residence into a trust and then rent to yourself and then take all of these deductions for renting to yourself. But people do try to do it. That would be an example of an abusive trust arrangement. Abusive or fraudulent trust arrangements may promise such benefits as deductions for personal expenses paid by the trust, depreciation deductions for an owner's personal residence, a stepped-up basis for property transferred to the trust, a reduction or elimination of self-employment taxes, or the reduction or elimination of gift and estate taxes. Now, a trust arrangement has to be a legitimate trust arrangement. It can't be used to basically transform a person's personal expenses into deductible items. When trusts are used for legitimate business, family, or estate planning purposes, either the trust or the beneficiary or the grantor, in the case of something like a revocable living trust, is going to pay the tax on the income generated by the trust. Basically, someone has to pay the tax. If the trust is generating income, either the trust has to pay the tax or the beneficiary has to pay the tax. If not, there is a chance that the trust is an abusive trust arrangement. Trusts can't be used to transform personal expenses into deductible expenses. A taxpayer cannot use a trust to avoid tax liability by either ignoring the true ownership of the income and the assets or the true substance of transactions. That doesn't mean that people don't try. People do try to get away with this. However, do not confuse an abusive trust with a legitimate trust that can be used to pay the living expenses of a disabled individual. You can have a trust that will pay your living expenses. That's okay. It's just that if the trust is generating revenue, then someone has to pay the tax. The tax has to be paid either at the trust level or at the beneficiary level when the income actually gets passed through. In the case of a qualified disability trust, the income generated by the trust is taxable, usually to the beneficiary, although the trust itself is allowed a higher exemption than other trust types. So a qualified disability trust actually will avoid certain types of taxes. Like it will avoid the kiddie tax. You can also retain the entire exemption amount to the trust tax-free. That's fine. That's all legal. But you can't use a trust to try to transform your personal expenses into deductible expenses. Now, let me give you an example of an abusive trust. Now, the IRS does catch people doing this all the time. But this would be an example of an abusive trust arrangement. Example, Curtis transfers his family residence and its furnishings to a trust, which he rents the residence back to Curtis and his own children. He deducts depreciation and the expenses of maintaining and operating the home, including landscaping, pool service, and utilities. Curtis's second trust transfers assets to the sham charity fund, which claims to be a charitable organization, but in fact is not an IRS qualified exempt organization. The trust pays for personal, education, and recreational expenses on behalf of Curtis and his own family. The trust then claims the deductions on its tax returns. Both trusts Curtis created are fraudulent. These are fraudulent trusts, and he would be subject to civil and criminal penalties. Now, really briefly, let's just talk about foreign trusts very briefly. The IRS gives increased scrutiny to foreign trusts because of their growing popularity in foreign countries that provide financial secrecy and impose little or no tax on trusts. These are often in tax haven countries that are outside the jurisdiction of the United States. An example of a tax haven country would be something like the Cayman Islands or Panama. A trust is considered foreign unless a U.S. court supervises it and a U.S. fiduciary controls all substantial decisions. Many foreign trusts are treated as grantor trusts with income taxable to the grantor that should be included on Form 1040. U.S. taxpayers who have an interest in, or even just signature authority over, if you have signature authority over a foreign trust, then you are required to file the FBAR if the aggregate value of the foreign trust accounts exceeds $10,000 at any time during the year. The IRS watches foreign trusts for abuses really carefully. It's not to say that every foreign trust is abusive, but many people will create foreign trusts in order to hide assets offshore. So there's a lot of additional reporting requirements that go along with foreign trusts. It's not as simple as just filing a Form 1041. You have to file the FBAR. There's specific additional foreign reporting requirements as well as regular tax reporting. Now, let me give you an example of an abusive foreign trust. Rosemary is a U.S. citizen with substantial business income. She forms an asset management company as a domestic trust, listing herself as the director and her son as the trustee. She then forms a business trust very similar to the domestic trust, with both intended to show she is not managing her own business. Next, Rosemary forms a foreign trust in Bermuda, with the income from the business trust distributed to this foreign trust. So the income from the domestic trust from her legitimate business is being funneled to a foreign trust in Bermuda. Because the source of income is U.S. based and there is a U.S. trustee, this foreign trust has filing requirements which Rosemary wants to avoid. Her next step is to form a second foreign trust. The first foreign trust funnels all of its income to this second foreign trust, which has a foreigner as the trustee. Since the trustee and the sources of income are now foreign, Rosemary claims that there are no U.S. filing requirements. In actuality, she retains control of the income on this second foreign trust and has set up an elaborate scheme to evade U.S. tax laws. This is an abusive trust arrangement. And people do try to do this sort of thing. They will create like foreign trusts or foreign corporations in these tax haven countries and then funnel U.S. income to those foreign trusts, attempting to hide income. That's why they do it. Okay, that's the end. Please check out the other videos and good luck on your exams. Subscribe to PassKey Online for more great content about the Enrolled Agent exam.